There's a sector that we've been told matters. We've been told over and over that this sector matters most, but it hasn't mattered since 2007. We have to talk about that sector and the one price chart that's breaking out that's telling us things are about to change. Stick around. Hey everybody, RC Peck here with Fearless Wealth, and I want to show you two specific charts, but I'm actually going to end up showing you four. Now, one is about a sector that we think matters, but I don't think it matters anymore. The second one is about the strength of the stock market. Now, this matters for retirement because if you want to retire strong, if you want to stay retired, you have to understand the stability and the direction of the stock market. And too many times we're taught to turn our attention to a part of the market that doesn't matter anymore. So we have to talk about a part of the market that doesn't matter anymore. So let's get into it. Let me jump over to the price charts. So let's do this. Let's start with the sector that I don't think matters anymore, or doesn't matter as much. So the sector is the financial sector. Now, if you look at the screen, or if you're listening, I'm showing you a price chart going back to 2003. It peaked. It stopped going up at the very beginning of 2007. So if you're doing the math, that's about 16 or 17 years ago. Now, this price chart is the financial sector divided by the S&P 500. It's known as a relative price chart. So the financial sector relative to the S&P is basically dead. It died in 07 and 08 and never got up off the ground. There's a lot of words spilled on how important the financial sector is. And I think it used to be, and of course it can't implode. You can't have the major banks implode, but no major banks are imploding and not a lot of them are. Yes, we had the second, third, and fourth biggest bankruptcy back in March, but the market didn't really care. And I think it's because of this price chart. It doesn't matter. The market doesn't care that much about financials anymore. You get your loan, whether it's a real estate loan or a commercial loan, and that's about it. Banks have really changed. So I don't think financials matter as much as they used to. So that's the one price chart I want to show you. The second one that I talked about is this one right here. Now I have two more I want to show you after that, but this one is the S&P divided by, basically this is the US stock market divided by the US bond market. And if the black line is going higher, that means the stock market's getting stronger relative to the bond market. Your brain can probably see, I'll show you, this is where the stock market stopped going up. That was in the end of 21, the beginning of 22. You can see that the price is now above that. So the S&P priced in US bond units is now above that point. It's breaking out. There was a false breakout in April of last year, but we've moved past that and it's breaking out. And so this is telling us the strength is coming back to the stock market. Doesn't mean the bond market's going to crash, just means the stock market is now outperforming the bond market. Now, those were the two charts I wanted to show you. I wanted to show you two additional charts. This is regional banking, KRE. I've talked about this quite a lot, probably March and April mostly. And now we have to wait to look for a bottom. The bottom could have come kind of right there. If you're looking at this, that's about $38. I thought if it kept weakening, it could drop to COVID lows, but it never did. It found a bottom. It actually bottomed in May. So this adds strength to the market's overall strength that regional banks have now bottomed. Now look, it's not officially called the bottom until it breaks out to a new high, but we had a technical bottom called a 1, 2, 3. It's moved higher. It's now getting close to kind of back to the March 9th, the scene of the crime. So we had, would we have Silvergate fail on March 8th, Silicon Valley Bank fail on March 10th. So we're getting back to those prices where the market's saying, hey, we're back to getting right back to where the crisis started. So that's a sign of more stability. Now, banking itself's not out of the woods and financials aren't out of the woods, but they're not causing a problem now. That's the big thing, right? They can hurt, right? They were hurting, they were slowing down, but now they're kind of out of the way. Last week's video, I talked about a lot different parts of the market hitting its, December 21, January 22 high. Technology is one of those sectors that has been leading the market higher. And it is now back to where it sold off at the end of 2021 and the very beginning of 2022. If that breaks above and out of that, that's going to bring huge strength into the market. You already see the S&P relative to the bonds strengthening and breaking out. You have Europe that has already gotten to that area, right? We talked about that, where Europe's in that resistance zone and getting to it. Germany and France are breaking out to new lifetime highs. So strength is spreading. Now, Europe got there first, international got there first, and it's kind of going sideways. So on a relative price chart, it looks like Europe and international aren't doing as well, but they're just digesting what's called that overhead resistance. And now we have tech back there. We have semis back there. Does not matter if financials ever get back there. It does not matter if KRE regional banks get to new highs. They just can't be imploding. I think that's a low bar. So the markets are shifting. They're telling us there's more strength, and that's bringing more stability into the markets, even though we have we have 5.25, somewhere between 5 to 5.25 in the federal funds rate. It's a range, but the market is digesting that, and the market is moving higher. Let me know where you think I got it right, where I got it wrong. Leave a comment. It matters. It matters most to your retirement because you want to make sure you are allocating your money to the strongest parts of the market. And most people's portfolios were designed in the 1950s. True. And they're using that same portfolio strategy today in the 2020s, and it's not going to work out the same way. Thanks everybody for being here, and I look forward to seeing you on my next video. Okay, bye.